Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Pisani, joined today by Tom Lydon, ETFtrends.com, Alfred Eskandar of Salt Financial. Let's get started with the sell-off rocking Wall Street. Dow down 700 points right now. The S&P having its worst day of the year. Nasdaq's down more than 3%. The trade war is escalating. Technology, consumer discretionary, industrials getting hit the hardest. How exactly can investors hedge against more volatility? Tom, you and I have been down this road before. And the usual game is, let's go with minimum volatility ETFs that are out there. There are several big ones. iShare has a whole suite of them. And mostly you're dealing with names like Visa or McDonald's or Pepsi. I guess the concern I have about saying, let's go to minimum volatility is if there is a global trade war, global earnings and global growth is going to come down. I don't care if Pepsi's not much in China. Pepsi's going to come down too, right? I mean, is there some logical problem with going to minimum volatility?
It will, but the S&P 500 is not the S&P 500 that we knew 10 years ago. Kind of go growth, higher Ps, more technology, more financials. When you look at low volatility ETFs, there's more consumer staples. No matter what the market's doing, people are still going to buy McDonald's. They're still going to buy Pepsi. They're still going to take their trash out.
Right.
Those types of things are always going to be stable, tend to be more value-oriented. Value has underperformed growth in the last 10 years. We continue to talk about that as far as fundamentals in the marketplace and factors in the marketplace. It's all been growth, it's all been momentum, and those are the areas that are getting punished the worst.
Well, Alfred, we know the biggest movers this year, sector-wise, all are cyclical. We saw technologies being big mover, consumer discretionary big mover. They're up 16, 17, 18%. Yeah. Am I being too paranoid by saying if you get a global trade war, I don't care what area of the market you're in, the market is fairly expensive and things have to come down. It's kind of hard to avoid it. You can say certain technology might be hit more, semiconductors might be hit more, but well, when overall expectations come down, the market comes down.
You can't avoid your market exposure. So, unfortunately, days like this are the greatest advertisement for low volatility funds and stocks. And what it's basically meaning is you're not going to get as hurt as far as the market moves down. So there's a little bit of a cushion. Tom picked up on something terrific with the sector rotation and some of the exposure to consumer staples. If I asked you over the last 70 years, you have to pick one sector that's going to outperform everything, nobody would have picked consumer staples. But that's the sector that has outperformed, not technology, not financials.
Well, wait a minute, not this year. You're not seeing no
I'm saying over a much longer period of time, it is the one sector. So if you have exposure to that sector during market, downturns like this, you're going to be cushioned going into, the next period.
So where do we go from here? We were just speaking earlier, Mexico's down 2%, Japan's down 2%, Brazil's down 2%. I think it's a 2% down world here on exactly what I've been saying.
It's all judging risk. So right now, there are a lot of fully invested investors out there that are feeling a little bit nervous.
Yeah.
If you feel it's late cycle in the market, you want to take a little bit off the table, that's fine. On the other hand, if you want to downshift a bit, there's some low volatility ETFs
Well, let's
out there.
put up a few of them. The
Sure.
iShares has got an interesting suite of minimum volatility ones. They've got a U.S. minimum volatility. They have a European minimum volatility. That's the EFA one there in the middle that you're looking at. And they've got an emerging market minimum volatility. You can describe a little bit about how they put these in there, but basically you end up with a lot of utilities and consumer staple names. I don't know if we have, I think we have the U.S. one up. It's iShares, it's Visa, Waste Management, McDonald's, Pepsi. Top 10 holdings are only about 14%, so it's pretty spread out if you want to look at what's in this particular
And the
ETF.
thing that jumps off at me here, it's not just the U.S., Bob, but individual investors are underallocated overseas in developed markets and emerging markets. Look to see if you've missed this emerging market move to play it in a low volatility way. And there's some great low volatility emerging markets.
Well, Pepsi is certainly very active in emerging markets, that's for sure. They're not terribly active in China, though, but they're certainly very active out there.
Yeah, same with McDonald's. That whole thing across the board. If you look at this as an opportunity and you're a long-term investor, have a 10-year horizon, boy, there's some great buys out there.
Yeah, Alfred?
Well, we happen to take a look at minimum volatility a little bit differently. We care more about beta stability, which is, how low volatility the stock is and how long does it stay that way. That's how we construct our low volatility fund.
We're going to talk to you about, you've got a new low volatility fund that's making some news today, but I want to get to the market volatility and talk to one of the great legends in the ETF business because he's here today and I want to pick his brain. So you've seen the market sold off, the volumes exploded. Did you see what happened last week in the Spider? This is the biggest ETF in the world, ever has been. We saw more than 70% increase in volume last week. It did 100 million shares 4 out of 5 days. This is a $280 priced equity, doing 100 million shares routinely now. It's early, but we're already pacing to exceed the average daily volume today. Let's bring in the man behind the SPY, guy who runs the SPY, Jim Ross of State Street Global Advisors. He helped mold the entire ETF business a long, long time ago, an old friend of mine. Thanks for joining us.
Bob, it's great to be here.
I got to pick your
beat day.
I got to pick your brains about this volume that you see. Investors just went right to the SPY and started trading it. It seems like what they want here is they want liquidity and they want tight spreads. Tell us how it's trading right now.
So I haven't specifically looked, Bob, but I'm going to bet it's trading at a penny-wide spread because that's what it does every given day, irrespective of volatility. And we see this when volatility comes in the market, and if I'm correct, the VIX is up over 20 today. I think last time I looked it was at 21, up 30% for the day. When you see that happening, SPY is going to trade at very high volumes. Investors use SPY to get in and out of the markets all day long during volatile markets, and it's the most heavily traded equity security in the world. It trades 3 times more than Apple. So from that perspective,
wait, the dollar volume you're talking about.
Dollar volume is 3 times more.
3 times more than Apple's dollar volume.
Yes.
Well, that makes sense.
Equity security in the world.
About 100 million shares and $280. Do the math on that. How? We know ETFs are used for tactical purposes by active traders, but it really is used tactically for the SPY. Can you make a stab at what percentage of the trades are just long-term buy and hold guys that want to just sit on it and use it as a core asset versus hedge fund guys who are coming in, moving out, in and out every day?
So, Bob, obviously with volume like that, there's a significant amount of that spook that want to go in and out. But there are long-term buy and hold shareholders in SPY. They've been in there for a very long time. They trust the liquidity profile. They trust the market resiliency of SPY and the consistency of the spread. You know, we've talked a lot in the ETF industry over the years about total cost of ownership. And I think when we talk about that, people just think about price. And I want people really to look at total cost of ownership and include everything, include the spread, include the consistency of the spread in volatile markets when you may want to execute a trade.
Wait, well, I'm going to pin you down a little. Obviously, the SPY has been criticized because you guys charge a lot for this product. It's 9 basis points. That's been, you've lost some assets under management to your competitors. They charge less. Vanguard and iShares at 4 and 3 basis points. Are you asserting that you're worth the extra money because in times of stress like this, you get tighter spreads and better liquidity than your competitors? That's a pretty bold claim because these are pretty big ETFs.
Yeah, and I'm going to say yes, 100%. Because if you look at different points...
Could you demonstrate, for example, that the SPY has tighter spreads and better liquidity than the competitors?
We can demonstrate that in times of volatile markets, without any question. If you look at Q4, and if you look even, I'm going to guess today, SPY is consistently stayed at that 1 penny spread. And think about that, 1 penny on $280.
Tom, you watch this. Is this a little bit of a sales job that we're getting for SPY over here?
No, it's fact. And as we're talking about trading here, the difference in expense ratio doesn't matter if you're trading regularly. What you want is execution. It's all about liquidity. And if on any given day, SPY is 40 to 45% of overall ETF trading volume, that says something. Now, again, there are other S&P 500 ETFs that do a good job.
It's the opposite true. Does it mean that the other ones don't have the tight spreads necessarily? We know when the market gets down like this, a lot of big names, the spread widens. Okay, so we know this maybe because market makers are better at risk management. They widen the spreads out to protect themselves a little bit. And yet your assertion, which is rather remarkable, that there is no widening in the spread here.
There's no widening in the spread of SPY. Yeah. And I'll give you an example. I'm going to give you a client example versus me. One of our clients was on stage at a conference last week and got asked the question, what S&P 500 ETF do you use? He goes, I use SPY. Reporter questioned him, said, why would you use SPY? It's 3 times more than the cheapest one. He goes, because I trust the confidence of the market that I can get in and out of that anytime I need to, and that's more important to me than a couple basis points.
The other thing, of course, that's important is 9 basis points doesn't matter if you're moving in and out. If you're a tactical trader, that's not going to have much of an impact on your overall thinking. So that would make some sense.
But even if you're, tactical every day, yes. Even if you're tactical over months, Bob, it does matter over time. And I'm not just talking SPY here. You go to the most liquid sector ETFs, you go to the most liquid industries, you go to DIA. It's very important to make sure you're looking at the underlying liquidity profile of your ETF, because the cost of execution can far outweigh the couple basis point saving in expense ratio.
And one other thing just to throw in, 90% of those trades are actually swapping a basket with somebody else. It's not the creation.
People ask me about this all the time. Can you tell us, I say most of the time, the vast majority of the time, a ETF like SPY will trade and the underlying stocks don't trade. There's no redemption or creation of the underlying. Is that correct? And can you tell us what the percentage is?
Yeah, I don't have the specific percentage, Bob, but think about it. SPY on average will turn over $15 to $18 billion today. Volatile day like today could be 28, 30 billion. And the underlying action could be $1 billion one way or the other, could be 5. But it's not consistent on a daily basis, but it's never the same amount as the trading volume.
Okay.
It's never happened.
Okay.
Yeah.
Appreciate that. Appreciate you clearing up that. Yeah. Great to have you, always, old friend. Moving on here, how would you like to get paid to invest? I find this amazing. Well, believe it or not, it's getting closer to reality. That's right, Salt Financial's low true beta ETF is finally active, paying investors to buy in for its first 100 million, and it just got clearance from the SEC to officially get its incentive program going. Alfred, this is your baby. Break it down for us. We talked about this a few months ago, but you're going to be paying people to hold your ETF. How does this work?
Yeah, essentially, we're going to waive the 29 basis point fee for the fund, and the advisor will be contributing 5 basis points to the fund, essentially paying the end holder of the fund.
And this is a low volatility fund. Describe what's in there. Was it like the minimum volatility funds we were just talking about?
It's similar. It's actually outperforming it today a little bit, so I'm kind of happy about that. The fund is focused on low volatility stocks. It's a 100 stock basket, equally weighted, sector cap, so you're not making a particularly sector bet. And it's rebalanced quarterly. It is using our technology, True Beta, which is what we believe to be a more accurate measure of market risk. So when you're looking for risk-off days like today, you want to be in a fund like this because it gives you some downward protection.
And what's the bet here? Obviously, It sounds like financial suicide, but you're making a bet what? That you're going to attract enough assets under management so that the fund will essentially take off after that first year?
Sure. It's very similar to a lot of industries where you will have a newcomer offer an incentive to attract new customers to get attention. But one of the second, and really the biggest reason we're doing this is these arbitrary hurdles to get on broker platforms. So imagine you've got this amazing organic bread, but you can't sell it in Whole Foods because there's no shelf space. So no matter how good it is, you can't sell it. So we're trying to attract attention. We also believe investors are going to stay put because of the value and the differentiation of the product.
Jim, you're a veteran of the fee wars. You've been around since the very beginning. We call it the race to zero. Is there a bottom here? And what happens when everything kind of goes to zero eventually? Who survives in this?
Well, so zero's tough. I'm not going to kid you. And paying people is even harder. Yeah. So from that perspective, but I do think, listen, investors want to look for long-term value. And I get that the expense ratio is the one thing they can see. They need to look at the whole total picture. That's what I worry about, Bob. And this isn't new for me. This isn't just because we're talking about liquidity today. We talk about total cost of ownership. I've been talking about it for 10 years, probably 15 years. A lot of different folks are asking about it today. I'm like, it's really important. I think it's interesting. You can come up with different ideas to come into the market, waivers and stuff like that. But it's really about what's the right long-term investment for the investor.
Is there any future to this, to negative
Well, I think
returns?
there is. I mean, we're going to hit a certain level of ETFs. We're maybe 2,200 right now, but 500 are opening, we're 500 are closing every year. It's a unique way, and as Alfred said, it's really important to get on the platforms. If this can get you up to that critical level, $100 million, all of a sudden you're going to be on the Morgan Stanleys and the Schwabs of the world.
And the symbol LSTR, is that right?
LSLT.
Excuse me, LSLT. All right, thank you, Alfred. Appreciate that. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Jim and to Alfred and Tom for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday. Same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter. your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds. Expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.